A US court rules Donald Trump's reciprocal tariffs are illegal, but they'll keep going for now before an expected Supreme Court ruling. The Fed is still expected to cut later this month after key inflation data met expectations. That's coming up in our 5 Things in 5 Minutes on Monday, September the 1st. And in our deep dive interview, ANZ's Chief Economist for Greater China, Raymond Yeung, unpacks China's plans for a digital renminbi.
China going to have a major leap forward in terms of how they see the role of renminbi in the world.
But first, in 5 and 5 with ANZ, late on Friday night, after markets closed, a US appeals court ruled Donald Trump's reciprocal tariffs were illegal. They've been in place since August the 7th and are now generating tens of billions of dollars in revenues for the US government. The US administration is expected to appeal the decision to the Supreme Court, so the tariffs will remain in place for now. Here's ANZ Group Chief Economist Richard Yetzinger to explain.
This has been the subject of much speculation. The Trump administration's tariffs are put forward under IEPA, the International Emergency Economic Powers Act. A lot of commentators have had the view that that's not what the act was designed for. The current circumstance is not an economic emergency of the sort the act was meant to cover. There was a ruling back in May. The Court of International Trade said, yes, not covered by IEPA, so the tariffs are not valid. And the Court of Appeals for the Federal Circuit Court on Friday also ruled in a count of 7-4 that the tariffs are unlawful. They will remain in place under that ruling until the 14th of October. Sometime between now and the 14th, you would think the administration will appeal to the Supreme Court. So there's some water still to run under the bridge. But obviously, if you are hoping for this ruling, viewing the tariffs kind of negatively from an economic perspective, as a lot of people do, I think this is quite encouraging news for the global trading system.
As of 4 a.m. Sydney Melbourne time, the S&P 500 and Nasdaq closed down 0.6% and down 1.2% respectively. The US 10-year Treasury yield rose 1.9 basis points to 4.226%, and the 2-year fell 1 point to 3.62%. Gold rose 1.2% to $3,530 an ounce, just below its record highs. West Texas oil futures fell 0.9% to $64.01 US a barrel. The US dollar index was flat. The Aussie dollar rose 0.1% to 65.41 US cents, and the Kiwi was flat at 58.84 US cents. Number 2. US inflation data out late on Friday showed core personal consumption expenditure inflation was 2.9% in July from a year ago. Now that was up from 2.8% in June. Richard says this key measure, which is watched closely by the Fed, remains stubbornly above the Fed's 2% target, which raises doubts about the number of Fed rate cuts likely in the coming year.
The market has more than 4 rate cuts priced for the Fed over the next year. I mean, to some extent, we agree. We have 3, but the US economy has to be slowing. We need signs that inflation is coming down for those 3 to be delivered, and PCE suggests that inflation's pretty sticky. So the risk for the market on this is pretty clear, that the cuts just don't come as quickly as markets have priced. And in fact, I would agree with that. Markets seem too enthusiastic about rate cuts given where inflation is.
Number 3, China's Manufacturing Purchasing Manager Index results for August came in yesterday, showing an improvement from July, but still in contractionary territory. Here's ANZ's Senior China Strategist, Xiaopeng Xing.
The rebound was mainly supported by the large companies in the upstream sectors because the price in these sectors has improved significantly in the past several months due to the government efforts to fight against the involution.
Number 4, New Zealand consumer confidence fell again in April, reports ANZ New Zealand Chief Economist Sharon Zollner from the ANZ Roy Morgan survey.
That's the first time in a while we've seen 2 falls in a row, and at 92 it is actually the lowest level in 10 months. So consumers are clearly pretty grumpy. We do have the weekly data as the month went on, and we can see it did lift a bit in the last week after the Reserve Bank cut the official cash rate, but only back to where it had been early in the month. And really, given the volatility you can see week to week, I wouldn't read too much into that just yet. We'll have to wait and see what confidence impacts that cut has.
Number 5, Indonesia is scheduled to report inflation data for August later today. ANZ economist Crystal Tan expects a monthly increase of 0.1%, which turns into an annual increase of 2.48%. Now that's comfortably within the central bank's 1.5 to 3.5% target range.
Now, high-frequency data point to some stabilization in volatile food prices, while core inflation likely held steady with our estimate at 2.3% year-on-year. So, with price pressures well contained, we continue to see scope for another 50 basis points worth of cuts in the current cycle.
Crystal tan there. Now, in today's deep dive interview, ANZ's chief economist for Greater China, Raymond Yeung, unpacks China's plans for a digital renminbi.
Now, China has been pushing for the renminbi internationalization or to increase the use of renminbi for cross-border transactions. And to start with, is way back to 2009, the PBOC governor Zhou Xiaochuan make a seminal speech at the BIS and tell the world that, the world perhaps need to think about an overall exchange rate reform, and then do we still want to stick to the dollar-centric financial system? So since then, China has been pushing for the renminbi internationalization. Now, obviously, they have been proceeding this agenda in steps, and China had the exchange rate reform, the first one way back to 2005 and then 2015, and now it's 2025. Is China going to have a major leap forward in terms of how they see the role of renminbi in the world, especially with the backdrop of this de-dollarization concern, in the global markets after the new administration in the US. So then started to be a very interesting time, for China to think about whether it is a good window and a good timing to push for the role or the growing influence of the yuan in the global markets.
Walk us through some of the limitations here that you put in your note. You specifically mentioned Triffin's dilemma. Who or what is Triffin, and what's their dilemma?
Well, basically, this is an economic theory, by Professor Triffin, half a century ago, and mentioning about there's a dilemma. The world at that time, you think about whether the U.S. should be a global reserve currency, and it has been, a global reserve currency. But by doing so, there's also a cost for the U.S. because the U.S. has to be a supply or be a provider of the global dollar liquidity to the rest of the world. By doing so, they have to run a persistent current account deficit. But at the same time, the dilemma is once you are running this type of current account deficits for a long time, then the market or other countries start to question your credibility and whether you can sustain your economy. And ultimately, that may reduce or to dampen your credibility of your own currency, and you will no longer be a global currency or global reserve currency provider anymore. So this is there's a dilemma between the two. Now, we relate this try to relate our thinking on the renminbi to this Triffin dilemma by questioning whether China can be a global reserve currency provider, because China has been running a current account surplus for decades, and we expect that China will continue to be run the current account surplus, because even after this trade war, then Chinese exports been still very, very strong, and it's very difficult to replace China in the global supply chain. So can the renminbi be a global reserve currency even with a persistent current account surplus? So we need to think about this as a limitation for China if they want to push the yuan to be a global reserve currency.
Raymond Yeung there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, September the 1st. Catch you tomorrow with part 2 of our deep dive interview with Raymond. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.